Hello, Market Rebels! Well, last week we looked at risk migration and how risk never goes away. It just changes places. This week we'll look at an extension of that idea, the Peltzman effect. While you're trying to reduce risk, you may end up increasing it. Seatbelts create accidents. The year seatbelts became mandatory, something strange happened. Cars didn't get faster, roads didn't get worse, drivers didn't suddenly get reckless, and yet accidents didn't fall the way everyone expected. In fact, overall traffic fatalities increased. That sounds impossible. After all, seatbelts save lives. Every public service announcement, crash test dummy, and dashboard statistic tells us so. The idea that they could cause accidents feels like saying umbrellas cause rain. So what gives? It's not that seatbelts cause accidents. They don't apply menacing forces to the steering wheel and cause you to swerve off the road. Seatbelts don't change physics, they change behavior. When drivers feel safer, they behave differently, often without realizing it. It's not that drivers intentionally drive recklessly, but because their internal risk thermostat quietly recalibrates. It sounds like an odd idea, but it's one that any economist could have predicted. This idea was first posed by economist Sam Peltzman, who said when safety measures are created, people's perception of risk decreases, so they feel that they can afford to take more risk. And it's now called the Peltzman effect. It all boils down to this: people respond to incentives. When prices fall, people buy more. When risk falls, people buy more risk. Now you're probably thinking, I don't take risk just because I'm wearing a seatbelt. Well, you're probably right for thinking that, but that doesn't mean it's correct. The Peltzman effect doesn't argue that people deliberately take more risk when safety improves. Instead, it's something subtler and more important. When the perceived cost of failure falls, behavior adapts, often subconsciously, until risk once again feels normal. Seatbelts reduce the expected cost of mistakes. In response, drivers subconsciously adjust in lots of small ways. They drive a little faster, follow a little closer, take corners a little sharper, sneak a peek at a text message, run a yellow light they might have braked for before. No single change feels meaningful. No individual decision feels reckless. Yet when aggregated across millions of drivers and billions of miles, these micro-adjustments matter. Accident severity may fall, but accident frequency or exposure rises. Risk is not eliminated, it is redistributed. People still are skeptical of the idea. No driver says, I'm wearing a seatbelt, so I'll take extra risks today. But you do. You just don't realize it. To prove the point, economist Armin Alshin came up with an extreme example to show why it's true. He said, imagine that a law was enacted that required every car to have a 12-inch spear mounted on the steering wheel aimed at the driver's heart. That's an incentive, a disincentive, but an incentive nonetheless. How do you respond? You'd likely respond by driving slower, keeping more distance between you and the next car, and certainly never taking your eyes off the road to search for the cheapest gas on GasBuddy. In other words, you'd drive more carefully. And if you say, I just wouldn't drive, it makes the point even stronger. Your behavior is responding to new conditions. Now, remove the spear, and what happens? You go back to driving as before. In other words, you take more risks because things are relatively safer. If you used to ride a motorcycle without a helmet but now drive a Cadillac Escalade, you'll see the same effect. With seatbelts, drivers feel safer, so they increase risk. There may be fewer fender benders, but when accidents happen, they occur at higher speeds, so the severity increases. As we covered in the last podcast, risk doesn't disappear. It migrates to a different location, different time, or different form. With the Peltzman effect, it often migrates from frequency to severity. So does this effect show up in options trading? Well, that's exactly why we're talking about it. Selling far out of the money puts for easy money. New options traders quickly discover the idea of selling far out of the money puts. They're enticing. They have a low probability for the stock to fall to those strikes, so it looks like easy money. Traders sometimes call it printing money. But there's a problem. The further out of the money you go, the cheaper put options get. So with the stock at 100, the $90 put may be trading for 20 cents. That's not much money, so what can you do? Enter the Peltzman effect. Because it appears to be low risk, traders sell more puts. Rather than selling one put, they sell 10 to collect $200. Or perhaps they sell 20 puts to collect $400. It's easy to scale out into bigger and bigger dollars. After all, it's low risk, and if you're going to print money, you may as well make a lot of copies. However, the act of selling more puts creates a dramatically different risk profile. The amount of short gamma at the strike explodes. Traders think the stock is so far from the strike, so who cares? Or maybe they hear that other traders report a 95% win rate. But distance doesn't destroy risk. It stores it. By selling out of the money puts, it becomes a conditional risk. The moment volatility rises or price moves sharply, the risk that felt dormant becomes active all at once. Margin use expands, liquidity vanishes, traders are forced to act at the worst possible moment. The perceived low-risk trade now makes traders take more risk. Stop orders create safety and increase risk. Stop orders are often used to reduce the risk of big losses. And now that you understand the Peltzman effect, you can guess where this is heading. A trader may be willing to buy 100 shares at $100, thinking the worst that can happen is it falls to $80. That's a $2,000 loss. However, if he can use a stop at $95, he can limit the loss to $5, so now buys 400 shares. Mathematically, they're equivalent. Both are $2,000, but structurally very different. While they appear to be the same risk, a stop order is a conditional order. If the stock falls to $95 or below, the stop converts to a market order. However, what if there are lots of stops at $95 and lots of market orders trigger? You can quickly hit a liquidity vacuum and the stock price can quickly gap below the stop price, so the loss can be much greater than $2,000. For instance, in the year 2000, I was on an active trader options team where I saw an extreme example. The stock was Emulex, ticker EMLX, which was acquired by Broadcom, ticker AVGO, in 2015. The stock was a trading monster like many tech companies today in the AI space. Because the volatility was so high, one trader decided to trade the shares but use stops to protect the downside. He usually traded smaller lots, but because of the added safety, the perceived added safety, he was trading 3,000 share lots. And it worked great until it didn't. On August 24th, the stock had surged to over $100, so he wanted to get on the momentum train. But shortly after the opening bell, a press release hit the wires saying that Emulex had restated its quarterly earnings to change the company's reported profit to a loss, and that Emulex's CEO had stepped down. The stock dropped from $103.94 to $43 in 16 minutes. The trader was glad he used a stop until he found out he was filled at $70. That's what happens when tons of stop orders hit a thin limit order book at once. Trading was halted. The good news is that the newswire was a hoax, so shortly after reopening, the stock regained its value and closed at $105.75. The bad news is that it didn't matter, as the trader already sold and he was holding a $90,000 loss. He was adamantly complaining that it wasn't his fault. Well, losses don't have to be your fault to matter. They just have to take place in your account. His fault wasn't the stop order. His fault was trading in larger sizes because he thought the risk was lower. That's classic Peltzman. Long options are not immune. The Peltzman effect doesn't just apply to short options and stops, it applies to long options too. You may see a $100 stock which would cost $10,000 to buy 100 shares. However, traders often say, if I buy the $100 call for $2 or $200 total, that's the most I can lose, so it's less risky. Because of that, I'll buy $10,000 worth of the $100 call and buy 50 calls to control 5,000 shares. Because the call is perceived to be less risky, traders often buy more. Even if they don't invest the same $10,000 amount, they may buy 20 calls for $4,000. They still see it's less money than $10,000 and they control more shares. It looks like you're getting more shares for less money and less risk. What could be better? Is it less risky? Well, it costs less, but that's a reflection of the greater risk. Where's the risk? If you buy the shares at $100, it would take a very big fall to have a significant loss. It's like saying there's a 100-foot cliff, but it's a mile west of you. It's a risk, but any major risk is so far away that it's not much of a threat. However, if you buy a $100 call, you're saying it's a smaller cliff, perhaps only 30 feet, but you're standing right on the edge. If the stock closes at $100 or below, you lose the full $4,000. Remember, the downside risk lives with the stock, not the option. Whether options existed or not, the stock still has the same chances to fall below $100, and all of those outcomes for option losses get concentrated at $100. If the stock drops to $99, $98, $97, and so on, there are different levels of losses to the stock buyer. To the $100 call buyer, they're all the same. Well, that's obviously a misperception in why many traders end up with larger positions than they're comfortable holding, even though it may cost less. The Peltzman effect is not an argument against seatbelts, stop orders, or options. Safety tools save lives and options manage exposure. But they don't operate in a behavioral vacuum. It's a reminder that any system that lowers visible risk without addressing incentives invites risk compensation. In markets, that compensation often appears as leverage. So, whether you're trading shares or options, understanding the Peltzman effect allows you to ask better questions before placing any trade. If a trade appears less risky, where did the risk go? Where does it reappear? And probably most important, what does it mean for me if it does? Place trades according to how much you could lose under most conditions, and then under extreme conditions. But don't ever place trades based solely on the perceived risk. Risk never disappears, it only waits. But if you don't understand the Peltzman effect, risk will be waiting, probably camouflaged, and probably in much bigger size and severity. Every safety feature is also a temptation. Stop losses, hedges, models, regulations, each promises protection, and each quietly invites behavior that leans harder into risk. The Peltzman effect isn't a flaw in markets or people, it's a feature of confidence. When traders feel safer, they don't reduce exposure, they repackage it. And that's how risk survives every attempt to eliminate it. Next week, just when you think you've tamed the market through trades or technical analysis, the market strikes back with reflexivity. The reason you'll never train the markets is because they're always learning.